Hello there. I'm sure at some point in 2024 you heard about the Department of Treasury's FinCen's, to be specific, which is their financial crimes division, talk about the beneficial ownership information reporting requirement. And I'm sure you're thinking, what is that? And does it apply to me? Well, sit down, get a nice cup of coffee or tea, and let's go on a journey. I'm Robert Marks, and this is the Mercury Legal Sidebar. I think before we begin, and so that there is no confusion, I want to highlight that as of December 26, 2024, the U.S. Court of Appeals for the Fifth Circuit granted a stay of an injunction issued by the District Court in Texas Top Cop Shop, Inc. v. Garland. This injunction is in effect nationwide, and reporting companies are not currently required to file beneficial ownership information with FinCen. So there's a lot of uncertainty at the 11th hour. However, voluntary submissions are available if a company wants to be pre-compliant. BOI is a requirement under the Corporate Transparency Act aimed at enhancing transparency and the ability of FinCen and other agencies to protect U.S. national security and U.S. financial systems from illicit use and provide essential information to national security, intelligence, and law enforcement agencies, state, local, and tribal officials, and financial institutions to help prevent drug traffickers, fraudsters, corrupt actors such as oligarchs, and money launderers, or someone just hiding money and assets in the United States. It should be noted that the government does have a legitimate interest in prohibiting and protecting these activities. And so while there is a stay on the nationwide injunction, and of course no one can predict what the final end result will be, it is safe to assume that as long as the government is enforcing this rule, that it can prove that it has a legitimate interest for enforcing this reporting requirement. The Corporate Transparency Act was enacted as part of the National Defense Authorization Act for fiscal year 2021. Interesting to note that this was very popular in Congress, but not so much in the White House. It was passed by both houses of Congress, where it was then vetoed by then President Trump. The presidential veto was then very quickly overruled by 2/3 of Congress, and it became law on January 1st, 2021. FinCen claims that illicit actors frequently use corporate structures such as shell and front companies to obfuscate their identities and launder their ill-gotten gains through the United States. Not only does this undermine U.S. national security, they also threaten U.S. economic prosperity. Shell and front companies can shield beneficial owners' identities and allow criminals to illegally access and transact in the U.S. economy, while disadvantaging small businesses who are playing by the rules. This rule will strengthen the integrity of the U.S. financial system by making it harder for illicit actors to use shell companies to launder their money or hide assets. That's what FinCen says. That's what the Department of Treasury says. That's what everyone who voted for this Corporate Transparency Act through the National Defense Authorization Act back in 2020. It's hard to argue with that, yeah, sure, there are illicit actors out there that are utilizing all legal means in order to help benefit their illegal means. But it's funny how FinCen is arguing that this rule is aiming to minimize the burden on the small business company that has to report. And they argue and say, well, the projected expense of filling out this beneficial ownership information form will only be about $85, whereas the fee in creating that LLC in the first place was anywhere from $40 to $500. And so they're saying, see, it's not that big of a deal. But they're still creating a burden on legitimate business owners in order to try to go after illicit people. Now, this is a tale as old as time. You know, nefarious actors are used as an excuse for legitimate and good people having to have less freedom, less protection, less burden, administrative burden on their everyday lives. I mean, I can go on and on and on and on and on about the Patriot Act and how it was used as a justification for our privacy being reduced, but that's not what this podcast is about. I'm just using it as an example that the government, rightfully so, because the courts are very receptive to the government protecting us from national security interests. And so it's a legitimate argument that will probably hold up in court. It's just frustrating that with everything, the bad actors affect the good actors as well. But that is the life, that is the world that we live in. In the BOI report are 3 different categories that have to be identified: the entity or reporting company, the beneficial owner of said entity, and the company applicant that is filling out the BOI report. When it comes to the reporting companies, the rule identifies 2 types of reporting companies: domestic and foreign. A domestic reporting company is a corporation, an LLC, or any entity created by the filing of a document with a Secretary of State or any similar office under the law of a state or an Indian tribe. With a foreign reporting company, it's any corporation, LLC, or any entity formed under the law of a foreign country that is registered to do business in any state or tribal jurisdiction by filing a document with the Secretary of State or a similar office. It would be interesting to note that, so does that mean that if a company, a foreign company, is doing business in the United States but has not followed the rule of registering as a foreign company doing business in the country, does that mean that they don't have to file this and so they can't be fined for that? I mean, they're going to be fined for the first part, but not the second part. But anyway, just interesting distinction, if you ask me. And it should be noted that there are certain entities that are exempt from the definition of a reporting company. The 23 types of entities that are exempt include governmental authority, banks, credit unions, depository institution, money services, brokers or dealers in securities, security exchange, insurance companies, insurance producer, commodity exchange, accounting firm, public utility, financial market utility, tax-exempt entity, entity assessing a tax-exempt entity, large operating company, subsidiary of certain exempt entities, or an inactive entity. And now I'm sure you're wondering, well, what is a large operating company and why is it exempt? Well, in order to be classified as a large operating company for BOI exemption, the entity must employ at least 20 full-time employees in the United States with a physical presence in the United States and have filed on their federal income tax the previous year at least $5 million in gross receipts or sales. With that entity is exempt from filing the BOI report. Now, I'm sure you're wondering, well, wait, why are they exempt? And it's kind of funny when earlier FinCen was talking about how they're trying to minimize the impact of the small business owner, and here they are giving a full exemption to the big corporations. Well, the argument is that if they're an entity of that size with that presence, that they're not doing the illicit and nefarious activities that the BOI report is trying to find and stop. So take that as you will. Now, the other exemption that I'm sure caught your attention is the inactive entity. Inactive entities do not have to file. They're exempt from filing the beneficial ownership information report. In order to be inactive, you have to have been in existence before January 1st, 2020. You're not engaged in active business. You're not owned by a foreign person, whether directly, indirectly, wholly, or partially. And there's been no change of ownership in the preceding 12-month period, and no amount over $1,000 was either sent or received directly or through any financial account in which the entity or an affiliate of the entity has an interest in the preceding 12-month period. And you don't hold any assets, whether in the United States or abroad. And that includes, and I think this is a big one, any ownership interest in any corporation, LLC, or similar entity. So that's the reporting companies. Next, beneficial owners. Under the rule, a beneficial owner includes any individual who directly or indirectly either exercises substantial control over a reporting company or owns or controls at least 25% of the ownership interest of the reporting company. An individual who exercises substantial control over a reporting company is any individual who meets any one of these general 4 criteria. The individual is a senior officer. The individual has authority to appoint or remove certain officers or a majority of directors of the reporting company. The individual is an important decision maker, or the individual has any other form of substantial control over the reporting company. I think it should be noted that this is an extremely broad definition that could catch a lot of non-owners of the entity. It is not saying an individual who owns a percent of the business and has substantial control. It is saying an individual or entity who has substantial control. Interesting to note. Now, ownership interest is defined still. It's a lot more straightforward than substantial control, but still, it should be noted that any of the following may be an ownership interest. That includes equity, stock, voting rights, a capital or profit interest, convertible instrument, options, or other non-binding privileges to buy or sell any of the foregoing, and any other instrument, contract, or other mechanism used to establish ownership. It should be noted that something that is very popular with members of an LLC is dividing up financial rights and governing rights. And so what this is saying is, say that you have a 75% financial right in a business, but you have no governing rights. Well, you're considering an ownership interest because you have 75% of the LLC. But say we flip it around a little bit and say that you only have 15% financial interest, but you have 50% governing interest. This would bring you in as a beneficial owner. It's just kind of one way of highlighting that there are ways of pulling you in when you might not have the clear-cut 25% ownership stake. It is also interesting to point out that an option contract. So say, for instance, you have the right of first refusal to purchase X shares in X years. Is that making you a beneficial owner because you have a potential ownership interest? You know, there's a joke going around that if you gave 25 lawyers a big corporate account and told those 25 lawyers, to file the beneficial ownership information report, that you would get 25 different answers of who is a beneficial owner, who has an ownership interest. Interesting. But I can see how there is some grayness here, and some attorneys or other company applicants might be lean a little bit too on the safe side, and some might lean a little bit too on the dangerous side. And, you know, there's a happy median, obviously, to any form of regulatory reporting requirements. This isn't unique to this BOI report through FinCen. I mean, this is true for almost any federal report or form. So I don't think that's really that unique or different. But still, interesting to talk about how the guidelines that are given in the rule create in my opinion, too much vagueness of what exactly they're trying to limit who actually is a beneficial owner, but based on the rules and the definitions, it's too broad. It's going to bring people in that probably don't need to be in the BOI report. But that's just my 2 cents. And as a reminder, Mercury Legal Sidebar is not giving you legal advice, and there is no attorney-client relationship formed by listening to this podcast. But I appreciate you listening to this podcast, and a lovely friendship can form, viewer and podcaster, from it. And I appreciate you for that relationship, but not an attorney-client. So now, company applicants. It's interesting that the rule put a requirement in that a reporting company is only required to report its company applicant if it was created, the company, the entity, was created on or after January 1st, 2024. All corps, LLCs created before January 1st, 2024 are not required to report its company applicant, which is kind of weird. But there you go. Anyway, the company applicant is the person who is the direct filer, the person who is filing this report with the Department of Treasury's FinCen network. Also, though, it is anyone who had the direction or control in filing the action. So say someone directed someone else, the direct filer, to file the application but filled it out, you also have to report on that person, the person who was primarily responsible for controlling the filing of the creation or registration of the first document. So that person is also a company applicant, even though that individual did not actually file the document. That's pretty much it. Interesting, but there you go. Okay, so now hopefully you have a little bit more understanding of what exactly is included in a BOI report. So now let's talk about some of the concerns of this reporting requirement. And I think the first one is pretty obvious in terms of the compliance challenges of just even understanding the reporting requirements. I mean, who is a beneficial owner? Who has substantial control? What is their ownership interest? I mean, the guidelines make it to where it could be incredibly broad. And I think that is a concern. And I think that the court, that's primarily one of the reasons why I think there's been an injunction. And the Court of Appeals issued a stay on that injunction, which we'll get to here in a second. And also something else to think about is just the complex ownership structures of certain companies that are multi-layered or even have international ownership, and will make it extremely challenging to accurately report on their beneficial ownership structure. And, you know, the penalties for noncompliance, there are severe fines. It can start at civil penalties of up to $500 for each day that the violation continues. There's criminal penalties, including imprisonment up to 2 years and up to a fine of $10,000. For any senior officer of an entity that fails to file a required BOI report. That's can be very significant. You know, I mean, hopefully you're listening to this report and realizing, oh, wow, let's just go ahead and voluntarily submit our report just so we're covered in case this court case is ever settled and the reporting requirement becomes mandatory again. That's not a bad suggestion. Not telling you to do that, but that's a thought to think about. Another concern is just the privacy and confidentiality. I mean, part of the benefits of LLCs have always been in terms of shielding members from, you know, just potential issues with people knowing who owns what. And this sensitive information is now being disclosed. Now, as of right now, it's only being disclosed to governmental and financial institutions, but so there is controlled access, but with that data out there, there's a risk of bad actors gaining that information, or also down the line, future legislation making it to where more third parties are allowed to access that information. And also, like, you know, and let's not sleep on the cybersecurity risks. I mean, the idea that a data breach from a government institution is not possible is laughable. And so anytime that you're giving information that up until recently was a lot more protected, that's a concern to think about. And, this administrative burden, I mean, sure, for the small, single member, under 5-member LLC, it's probably not that big of a deal. But the bigger you get and the more complex you get, you can imagine how maintaining these detailed and updated records can be very complicated. And, something to note is anytime the beneficial ownership changes, the entity has 30 days to update their beneficial ownership information report. So now we go back to the uncertainty of the regulatory compliance of who is a beneficial owner. So if you are more conservative and decide to have a wider swath of who is considered a beneficial owner for your report, well, I mean, that's anyone who has substantial control. So you hire a new person who has substantial control over the business. Now, do you have to file a new report in 30 days? You have to do that every time. If they quit and they're no longer a beneficial owner, do you now have to file a new report? That is complicated. And I think that is a legitimate argument. And the biggest question is the use of this information. So, how are federal, state, and local authorities able to use and share this information? Is it just going to be for the Department of Treasury's FinCen, or is it going to be misused beyond its intended purposes, like targeting the business for unrelated investigations? I know that sounds a little conspiratorial, and it might be, but I think it still is a legitimate concern. And as someone who is a strong advocate of privacy and utilizes the LLC as a privacy shield, not just a liability shield, but a privacy shield for his clients, I do see, and I hate the slippery slope argument, but I do see how this could be a weakening of that privacy shield. Whether you agree with it or not, that's your business. And, the government, like I said, the government does have a legitimate interest in national security. But a legitimate interest doesn't give the government a blank check to do whatever they want. Well, at least it shouldn't. But, again, that is for another day. The U.S. District Court for the Eastern District of Texas issued a nationwide preliminary injunction on December 3rd, temporarily halting the enforcement of the CTA. The court raised concerns about the constitutionality of the law, pausing its implementation. The lawsuit alleged that the CTA falls outside the Congress's powers to regulate interstate commerce and foreign commerce because it regulates incorporated entities regardless of whether they engage in a commercial activity. The government argued that the law's function to crack down on anonymous shell companies and deter money laundering, terrorism, financing, and other illicit economic activities falls within Congress's regulatory duties. And by creating a corporation or an LLC or other entity, you are engaging in a commercial activity. It's interesting to see how that second part plays out more so than the first part. I do think that the government does have a legitimate government interest in deterring these activities, these money laundering, terrorism activities, and I think that in weighing the benefits and the burdens, that a court would side more with the government. Now, I think that second part, though, is worthy of discussion in that is the mere fact that you have an LLC. And remember, the BOI exemption includes inactive entities. So you can have an LLC and be exempt under this rule if you aren't engaged in a commercial activity, which is interesting. So it's saying that having the LLC, you are engaging in a commercial activity. But if you're not engaging in a commercial activity, then you're exempt. So I think there is a fun little argument there. It just goes to show there's so much uncertainty in business law right now. I mean, between this and the non-compete ban, remember, which was supposed to go into effect months ago, but has a similar injunction out of Texas as well. And with the incoming administration, the odds that the non-compete ban will be enforced long-term is It's very low, I believe. I think that is definitely going to come about. And I think that, especially considering that President Trump in his first term is the one who vetoed this bill originally, and the Congress over 2/3 overruled his veto, the executive branch as a whole will probably try to find a way to have some form of compromise in where there is some protection for these illicit activities, but maybe that a vast majority of the entities, the reporting entities, can be exempt as well, kind of balancing this privacy rights, but also trying to have a certain form of protection from these anonymous shell corporations that are just funneling and laundering money. It's interesting to see what happens, and I look forward to it. This being December 30th, 2024, I appreciate you listening to this episode of my podcast that I started this year. And as we go into 2025, I just want to pledge to you and say to you that thank you for watching, and I hope that you continue to watch or listen. This episode has been an experiment in that I am doing a audio-only version to see that if it is a little more seamless. My goal is to release at least one episode a month, so that'll be 12 for 2025. Let's hope that I can stick to that. I hope that you listen and hold me accountable to it. But I'm interested to hear from those that listen if you miss seeing my face as I talk, or is this audio sufficient enough? I'm still on the fence if it truly alleviated a lot of issues in terms of the recording and the uploading. We'll see. As of now, I'm just recording it, so I don't know if it is just as easy now uploading it and publishing it and pushing it out there. We'll see. But, I'm sure you're wondering what I'm wearing. I'm wearing a polo. Shocker. My favorites. Anyway, I hope that you listen to this and now at least understand more about the beneficial ownership information reporting rule and what's included, what's required, and the uncertainty of how right now you can talk intelligently and say, hey, it is just a voluntary submission right now. And it would probably be a good idea. My number one tip, if you're still listening to this and you have an entity that is probably a reporting entity, to just determine who are your beneficial owners and just get it all together in case you do have to report. And, maybe it's a good idea to hire a professional like a Fractional General Counsel based out of Nashville, Tennessee, who will do this for you and keep you apprised of the situation, and we'll let you know, hey, you have to do it, or you don't. We'll see. Anyway, thanks. I appreciate you listening, and I hope you have a Merry New Year.